Today is Thursday, February 8th of 2024. We did multiple trades in our two option trading accounts today. Up top, you'll see above the thick blue line, and this is our small account. We did a new covered call in OZK at the $37.50 strike price, so that cost us $36.55 per share. If it's called away from us, it'll be called away at $37.50 per share, so about 95 cents here per share we have the opportunity to make if it's called away from us anytime before it expires on March 15th. And then also just a note here, since we'll talk about OZK all in one trade, down here our main option trading account, we sold a cash put option, the same expiration day, March 15th, at that same $37.50 strike price, and you see that we got 75 cents per share. So notice that we got actually 20 cents more per share for doing the cover call. Just kind of something to keep in mind. All right, so now we'll look at our charts here, and we see that over the past couple of weeks, Bank of OZK has had a sharp decline. It appears to be now trying to find support. And I'll be honest with you, I'm not 100% convinced that this is the final support. It's trying to find that around this red tuna moving average, and I'll tell you why in a second. But we do see it was a nice gap down. See, over the past week and a half or so, it's down almost 15%. See, it was high volume as it declined the first 2 days, and now volume's kind of starting to normalize. Yesterday we see a nice doji where sellers sold it down and buyers bought it back up. And today was lower volume, and it was a green up day. So that's telling us the sellers are still in control. So why do we do this trade? Well, we actually sold this strike price down here at 37.5, which means that Bank OZK can drop another about 10% before it's challenged. And notice over here on the weekly chart what that coincides with. They have to push through this red 200 moving average, and then it'd be right at the bottom part of this upward sloping trading channel that's been in, going all the way back into last year, back in May of last year. So we have a nice, clearly defined upward trading channel. Now, of course, it can break through there, but a bank that I like, and we have a starter position with that cash put option we sold our main account, and then a nice cover call that we can be wrong by 10% and still potentially get 100% win on this trade. So I like that. We'll look to add this position in our main ops trading account if it appears to be continuing to try to stabilize and the return is sufficient. All right, moving on to the next trade in our main account, we see that overnight we were assigned 200 shares of ADM at the $7 strike price that we had sold that cash put option. So we bought 200 shares at $70. And what we did is we turned it into a covered call by selling the March 15th $62.50 call. So notice that we sold it below where we were assigned the stock at, but as you'll see in a minute, it's pretty far out of the money. Then simultaneously, we sold the $45 puts. We have plenty of room to add this. We had only sold 2 cash put option contracts, so plenty of room to add to it. If we end up buying it at 45, I'm happy with that based on what I know about the company today. And just make sure you're well aware of what's going on with ADM. They have suspended their CFO, so we'll have to see what comes of that and what news comes out when they finally do announce earnings here, supposedly here in February. So we'll see how that plays out. So there are some issues. There is some risk here. Just kind of be aware of that. So a couple things. So we were assigned to up here at 70. It gapped down with the announcement of what potentially could be bad news for that portion of the company. If I remember correctly, it's only 15% of the company that CFO is involved with. Of course, it could be more widespread, so anything can happen anytime with any company. But so far, that's the information we have. So we sold the $62.50 put option. I wanted to be pretty far out of the money, which means that we sold that call option. We sold it 19% higher than what it's currently trading. That gives us the opportunity that if the news isn't as bad as the market's thinking, then ADM can go up, and we still hopefully can adjust this to get up and out of it by higher than 62.5, hopefully 70. And then we sold the $45 put option, which is way down here. So it can decline another $7, which would put it around 12, 13, 15%, somewhere in there if we're assigned more shares, which would lower our overall cost basis. So overall, we didn't collect a lot. We collected 41.5 cents combined between the two, and we'll kind of see what happens once they do come out with their earnings and kind of clarify what's going on with the CEO, what he did or didn't do. So that's our ADM trade. Now Disney, we closed out the DIS March 15th $85 put option for 4 cents per share. So we got that closed. We'll look to go back in at a later date. And I'll go ahead and talk about this other Disney trade here at the bottom. This was a poor man's cover call. We just exited. Disney had a nice advance, as you'll see here, after earnings. And we sold it kind of at the top of this candlestick here. We got out at the top of the candlestick, big high volume, but is running up against this red tuna moving average. And of course, we have nice high volume. So will it push through that red tuna moving average? It usually takes a lot of effort to do that. I tried to do it early 2022. Couldn't do it, so we'll see what happens. This is a nice big high volume candle today. So it wouldn't surprise me if it kind of consolidated, maybe even came down to retest potential areas of support, but of course it could blow through there. We went ahead and exited today and got our money back, $7.35, so $735. And we will look for an opportunity to go back into Disney. I really like the company. I like it long term, and just want to wait till it comes down to test some support. Our next position here, UPS. So we're in a covered call and cash secure put option in this, and we kind of rolled both of them to our benefit and still walked away with 90 cents per share. So what we did is, we'll start with the put first. We bought to close the February 16th 155 put and rolled it down by $5, but I had to go out to May and sold the 150 put. And as far as the covered call, we bought the 140 February covered call, rolled it up by $5, but had to again go out to May. So we got both of them rolled $5 to our benefit and still walked away with 90 cents per share. Our charts up here. So see that UPS, it did gap down, let's see, several weeks ago on the, about a week and a half ago, down back on the 30th. It had a nice gap down. And now it's trying to come back up, and it's kind of starting to find resistance here. And it actually is at the perfect spot for us to do this trade. That's why I went ahead and did it today, because it's kind of in the middle of that 155 cash secure put option and the 140 covered call. So happy to get those rolled down. Of course, we like to get them reversed. If UPS continues to show strength, we'll continue to try and roll that covered call back up as we roll it out. And then finally, EPD. So we sold to open two of the EPD March 15th, $26 cash secure put options for 23 cents per share. This is a company that really stable MLP. If you're looking for income, this is a nice company that pays a nice high dividend. It is MLP, so you kind of know the nuances of that. But it's just coming down to an area right here around 26 where it's found support multiple times in the past several months. I like the company. I don't want to be assigned in this account. I've been buying it in my outright stock ownership account. But in this one, that's not our goal. Our goal is to generate option premium. But if it is assigned to us, I'm okay with that. But like I said, it pays a nice high dividend. It's around support. If you look over here at the weekly chart, notice that if this does fail, this area right in here around $25.61 was a previous low back from this week here in November. And that would also put it right around in the general area of this red 200 moving average on this weekly chart. Notice there was high volume last week as the sellers sold it down. But overall, it looks like it's an area that could potentially find support. So we did a little small startup position, and we'll look to get out of this early if possible, because the return is lower than we generally like. But we like the company, like the opportunity, like where it's at, and if we can get out early, then we can increase our return. So I mentioned I talked about the SPX trade earlier in a post to a Patreon today, and just kind of want to talk you through what's going on with the S&P 500. Now, as you all know, I don't like to repeat the same thing over and over again. In case you haven't heard it, the markets can stay irrational longer than a trader can stay solvent if they're over leveraged. So just remember that you always want to trade, I won't say out of fear, because I think fear and greed are bad traits to have in trading. You want to trade based on logic, but you always want to be mindful of what could happen if things go against you in a bad way. So we've been selling naked call options against the S&P 500 for several years now. And we've currently sold the $4,900 naked call options that expire at the end of February, so you still have several more weeks. And so they are in the money by almost $100. So see, SPX closed at $49.97, so about $100 in the money. So the trade that's definitely gone against us. We had to roll up and out last month. If I remember correctly, the S&P 500 is trading about at the highest price to earnings just about that's ever traded. It may be the highest. I can't remember. It's in that general area for the long term. I want to talk about a brief moment in time, but for the long term, it's trading very high. The average is around the 18, 19, and it's trading at a 23. So if you believe in that sort of thing, the market is pretty overvalued. It's not fairly valued, it's overvalued. We have seen it's had a really nice run over the past year or so. It's up 18%. It's a nice high run. Year to date, it's up really good. Let's see, what is this? Mess with my lines here. It's up around 6.5%, give or take. So S&P 500 is really trading at a high clip here, high valuation, but as I mentioned, it can always go higher. So we are watching the $4,900 naked call option. I've already been running scenarios on how to adjust it. And one thing we could do, of course, is just roll it up and out. But I like to get it up in case it continues to go up in price. And if I don't want to, but if I have to, I would fund it by selling cash secure put options. But we don't really want to do that when it's trading way up here at the high part of this upward sloping trading channel. So it is due for a pullback. Will that happen? Well, we don't know, but it is due for a pullback. We do see high volume here. I'll switch over to the SPY, SPY. We do see volume has come down some. It's not trading as high a volume as it has been in the past, as it's been going up. So due for a pullback. Doesn't mean we'll get it, but we are watching it. And we have several different scenarios that'll play out for us. We still have nice time value premium in those short $4,900 naked call options. But we are watching. We're looking for an opportunity to roll them up and roll them out. No matter what happens, we'll look to roll them up and out. If we have to fund it, then I might do it either by adding to our naked call option, which I don't really want to do, or selling a bullish put credit spread. It would, of course, be at or below the bottom of this upward sloping trading channel. So that's my thoughts on the SP 500. So that's all for today. I hope you have a great evening.